Welcome to Go Green Radio, everybody. So glad that you could tune in and join us today. We have got an all-star panel of guests that will be talking to us about responsible business and investing. We're going to be making the case for ESG, environmental, social, and governance metrics. And I'm so thrilled to start with David Levine. He's the co-founder and president of the American Sustainable Business Network. Let's start with you, David. Today we're talking about responsible business and investing and making the case for ESG. Talk to us about how the American Sustainable Business Network helps businesses and investors make the case for ESG to their shareholders, clients, and customers.
Oh, that's great, Jill. Thank you. So just for those that don't know, the American Sustainable Business Network is an organization that's building a business community, partnering with business organizations, companies, investors, collectively representing over 200,000 businesses across sectors and geographies, all set up to advance solutions for a more just and sustainable economy and society. So we work to inform and connect and mobilize these business leaders and investors to transform both the public and private sector. And so that was the reason for our formation, and certainly sits as core to the work that we continue to do. And so we've always understood that, environment, social factors, and strong governance policies, or what's known as ESG, is really crucial to the work of the businesses that we represent. But we also have seen lots and lots of data, that really helps to really confirm the importance of this to our overall economy. So across sectors, size, geography, our members and our allies are aligned in understanding that a thriving and vibrant business and economic landscape is only possible over the long term if it prioritizes ESG. And, for us, it should really go without saying that businesses and investors should have the freedom to consider these factors that they deem necessary to inform their business decisions. And, their understanding that it helps their bottom line, their profitability, to be able to perform well on the environmental and the social factors as well. So we've been
Absolutely.
mobilizing a strong business voice and power under a responsible business investing campaign to work on bringing forward the data-driven, experience-based understanding and solutions that informed businesses and investors can provide for a path forward for business and the economy. So again, this sort of sits center for really understanding that, the ESG or these kinds of factors in the broader sense really provide for the solutions that we need to tackle our most pressing environmental, social, and economic issues. And so for us, our job is creating this broad network so that we can have this collective voice and power in order to move this agenda at the federal, at the state, and at the local level. And it really needs to be understood outside the political rhetoric that's been mounting these anti-ESG campaigns as to what just makes good business sense for our businesses and for the economy overall.
Absolutely. I want to bring on Alex Wright-Gladstein, the founder and CEO of Sphere. Alex, your backstory is great, and it's on your website, our Sphere, and I want everybody to check that out. How did you first realize how hard it can be to get a climate-friendly investment option in an existing 401k platform, and how is Sphere addressing that issue?
Yeah, I have my whole life, I've been really concerned about climate change and trying to figure out how I can have the biggest possible impact on turning it around. And I decided early on that if I could be a serial entrepreneur helping get technologies out of labs, that could be a good way to have an impact. So I started my first company spinning a technology out of MIT that cuts the energy use of AI in half by using light to move data between chips. And we did that in 2015. That company is called IR Labs. And now we have customers like Intel and NVIDIA. But back in 2017, we started offering a retirement plan to our employees. And I asked our providers for a climate-friendly investment option in the lineup. And it ended up taking over 3 years and a lot of persistence to get a single option that, as a baseline, wasn't invested in fossil fuel companies. And I couldn't believe how long it took and how hard it was. And so I started talking to people in the 401k industry to figure out why it was so hard. And I ended up learning that I wasn't alone. And it wasn't just other climate tech founders like myself that were looking for these options for our companies. It turns out there are entire social movements of employees at the biggest companies in the world, at Microsoft, at Apple, at Google, who've been asking for climate-friendly investment options on their 401ks for years, at some of them going back to 2016. And these are 401k plans that each have tens of billions of dollars of assets under management. And so whether it's at these huge companies or at smaller companies like mine at the time, people just aren't getting these options to invest in a climate-friendly way. And so I started looking at the factors impacting that and why it was so hard. And I realized there weren't any laws or any really good reasons preventing it from happening. It was just clear that no one had ever tried to make it really easy before. So I realized for my second company, rather than spinning another technology out of the lab like I thought I'd be doing, I could have a bigger impact on climate change if I could make it easy for everyone to invest their retirement savings in a climate-friendly way. Because there are over $30 trillion in retirement savings in the US alone. Of that, 1 trillion is invested in fossil fuel companies from people who have no option to invest otherwise. And that makes 1/5 of the market cap of the fossil fuel industry. And, in other categories of investor types, endowments, sovereign wealth funds, et cetera, there's been actually a pretty big exodus of assets from the fossil fuel industry. And I think it's in part because the writing's on the wall that this is an industry in decline as solar and wind and batteries and electric cars have been taking off. Demand for fossil fuels has been going away. And of course, it's just everyday people with their retirement savings getting left. They're the ones still investing in this industry that it turns out has already had decreasing stock prices over the past 2 decades. It's actually been a losing investment already for the past 2 decades as the industry has been in decline. And so realizing all of this, I realized, all right, I've got to start a company that is going to offer a better option to everyday investors so that it's not just the most wealthy and biggest pools of money of endowments and sovereign wealth funds that can have this option, but also just regular people saving for retirement. And so that's why I started.
I love it. I love it. It's so inspiring. I want to pivot to Amberjae. Amberjae Freeman is the board chairperson and CEO of Etho Capital. Amberjae, your company's on a mission to build the world's most sustainable investment strategies that achieve superior financial performance through true sustainability, climate science, and positive social impacts for a just economy. Tell us about the 3 layers of ESG screening that all equities in Etho Capital indices and strategies must pass through.
Thanks, Jill. I mean, our goals are certainly lofty, the way you make them sound. I guess the way we make them sound as well. We have a number of layers, not necessarily 3, but I guess at a high level, what I would say is the first layer, of course, for us, we are a group of climate scientists, environmental scientists, social scientists, basically every stripe of nerd you can probably think of. And our focus is effectively to try to figure out how best to use quantitative data and qualitative data to make the best investment decisions possible, the most informed, because ESG investing isn't just a quantitative measure of risk, it's also a qualitative measure of risk. So at a high level, we always start with climate because we're climate forward. So we use quantitative data to identify, to calculate total supply chain carbon emissions across a company's supply chain, so scopes 1 through 3. We then overlay sort of like and model their transition risk. Like, what will it take for this company to actually be able to meet, the IPCC's reduction benchmarks, whether it's under a 1.5 degree, Celsius scenario or a 2 degree scenario, out to 2030 or 2050. We apply the EU taxonomy. We look at sort of the, not sort of, we look at the impact investors, climate metrics, and of course, a variety of other different benchmarks and frameworks. And then we also, on top of that, add what we call scope 4, which is calculating sort of companies that are net positive. So it's not just about the negative impact that you're having on the environment. It's also, is your company's products and services, or the way in which you manufacture your goods and services, having a net benefit to the climate? So we look at that as well. I guess that's one. That's one. The two is, at that point, we do like a qualitative measure of risk. Who are the bad actors? When the rubber meets the road, whose performance is actually not meeting up to standards? We take an approach that looks at not just shareholders, which of course are incredibly important, but we also look at the stakeholders. When you look at who's at risk, what labor markets are at risk, what geographic regions are at risk due to or might benefit from a company's activities in their area. What impact are they having, positive and negative, and trying to find the delta between those two things. And then finally, of course, we do risk monitoring, and we look at corporate governance, which is, how well the company is managed, run, how well it manages its risks, including the ones that I already mentioned. So I guess those are the three tiers. It's comprehensive environmental evaluation, comprehensive, what is your impact on the environment and society? And I guess the easiest way to say that is, the way that I like to think of it is, what is the company's social license to operate, and how well are they adhering to the precepts of, good corporate governance, and what impacts are they having on our environment and our society? Because despite the way that the narrative often works, corporate activity doesn't exist separate from society. And for too long, corporations have been able to externalize the negative effects of their business activities off of their balance sheets and into the broader society, and then internalizing the profits. And so we're trying to bring that back into balance.
I love it. And, I was out on your website, and I really got a lot from reading, basically the answer to this question, the three layers that you all indicate on your website. And I think the word that kept coming to my mind was risk management. A lot of the things that you're looking at, are things that can make a company vulnerable to, whether it's, external environmental, things that could impact their supply chain or their raw materials. And some of the things that you're talking about are good old risk management.
Well, we're asset managers. It's our job to manage risk and optimize performance, so that way assets can exist into perpetuity. And from our perspective, our environment and our society are assets, right?
Yeah.
Like, we don't treat employees as liabilities.
Absolutely. Yep. We're going to take a quick commercial break, but when we come back, we're going to be introducing you to Josh Zinner, CEO of the Interfaith Center for Corporate Responsibility. So don't go away, folks. There's more Go Green Radio right after this. Welcome back to Go Green Radio. So glad that you could tune in. If you just joined us, let me catch you up. Today, we're talking about responsible business and investing. We have an all-star panel of guests today who are helping us unpack environmental, social, and governance metrics, ESG, and the case for continuing this important work in ESG. We're going to talk now with Josh Zinner, who's the CEO of the Interfaith Center for Corporate Responsibility. Josh, talk to us about your organization and how you mobilize faith and values-based investors to work collaboratively to leverage their investments to catalyze social change. Help us understand what that looks like in practice.
Thanks so much, Jill. ICCR, as we're called, started in 1971 when a group of faith-based investors began engaging with companies they were holding about business they were doing in apartheid South Africa, and really pioneered the movement of engaging with companies on environmental and social risks long before we heard the moniker ESG. Today, we're a coalition of over 300 institutional investors, asset owners, and asset managers alike. And our focus, we have over 4 trillion in assets under management collectively. Our coalition includes faith investors, but also like-minded investors like labor pension funds and other pension funds, and endowments and asset managers focused on responsible investment. What we do is we help our members collectively to engage with corporations on their environmental, social impacts and on good governance. Our members believe fundamentally that the way that corporations consider and mitigate long-term risks and how they engage with their key stakeholders, including workers, communities, consumers, and the like, is fundamental to their long-term value. So our members are investment fiduciaries who are responsible for growing their investments and for the long-term health of their investments, but also have a deep concern as faith and values-based investors on the impacts of corporate practices on people and communities and on the planet. So we're engaging with companies again to talk to them about their impacts in that area that we see as risks, whether it's on the climate, whether it's the way they treat their workers, the way that they're engaging in the political system, or the way that they're lobbying or spending. Our members, so what engagement means is fundamentally dialogue. So ICCR members are literally at the table in conversation with hundreds of public companies every year. And the conversation is always a conversation as investors, bringing to companies concerns about how their impacts will affect the value of engagements. Our members are constantly communicating through ICCR with a variety of stakeholders, including labor and worker groups, including community-based organizations, including NGOs who have issue expertise in the space, so that what we do is we bring to companies concerns about the direct impacts of their practices on people, on communities, and on the environment. And so these are long-term conversations with companies. And when many companies are able to make positive changes in response, and through the years there have been many to these engagements, when companies are not moving, or when they're not sufficiently addressing these issues, our members do file shareholder resolutions. And that's been a process that's gone on for decades, where shareholders are able to bring issues to the corporate proxy to be voted on by other shareholders. And that's often a way to get these issues in front of other shareholders, in front of the board and management, and really to help to propel ongoing dialogue. So the shareholder engagement process that our members are deeply involved in is really a really efficient private ordering process that enables long-term investors to have an ongoing conversation with companies about matters of long-term risk and sustainability.
Got it. Boy, that's powerful. That's a powerful way to work. David, I want to pivot back to you. I'd love to have you talk to us about some of the American Sustainable Business Network's policy positions and how you're navigating the current political environment.
Oh, great. Yeah, well, for us, it should be understood that we really believe that there's an important role for businesses to speak up right now. And there's a great deal of hesitancy on the part of businesses for fear of being targeted and the like.
Mhm.
So we really understand that there are a certain set of businesses that really did not believe in the importance of ESG, and the like, and so they've sort of been able to easily move away. There's others though that I think will continue to support these practices, but are careful about the language and how public that they are. And then there are others that are like these organizations, the businesses you're talking to today, Etho Capital and Sphere and the Interfaith Center for Corporate Responsibility and their members, and a number of our other members that have understood that now is not the time to be silent. Now is the time to speak up and speak truth to power, that really make the business case for this. So, for us, we've really understood that, a responsible business voice is really needed to sort of show up, whether it's in the media or it's in state capitals or it's in Congress or it's with the administration and the various agencies and the like, because it's often the business case that's made against what's beneficial for the environment or for communities and the like. But here we're able to make a like argument that, what we could say, with confidence based on the experience of the success of the investors and the like, and the businesses, is that it makes good business sense to pursue ESG. So we're working across a wide range of issues, the environmental issues from regenerative agriculture to clean water to safer chemicals and circular economy, over to inclusive economy, and also corporate responsibility and democracy. And what we understand is now more than ever, it's important that we show up, we make this business case, and we really speak out. But we've also understood that we needed to use a different set of tools, additional tools, including using the courts. So one of the more aggressive moves that we made was in August, the end of August, the American Sustainable Business Council, 501c4, sued the state of Texas on behalf of our members, including Etho Capital and Sphere, to stop the enforcement of their anti-ESG law, SB 13. And for us, there was a number of anti-ESG laws that were being offered up at state level, and we felt it was finally important for us to stand up as a business community and challenge this law based on free speech, our right under the Constitution, because this law penalizes investors that choose not to make risky investments in fossil fuels, but businesses that choose rather to pursue practices and products that build a more resilient, sustainable future and the like. So that court case is still going on at the moment. But like we're saying, it's important for business leaders to step up and speak out. And one of the ways that we could do that is we're trying to use our American Sustainable Business Network as a platform to be able to bring us together so that we can have the safety in numbers, but also the collective wisdom, experience, and power that comes from us working together.
Wow, that well said, David. Thank you so much for shining a light on the good work that you all are doing. Alex, I want to pivot to you. I want to ask you a really simple question, but I know the answer isn't necessarily simple. How is your company, Sphere, different from other climate-friendly and fossil-free funds?
It really comes down to the requirements of the 401k industry, because it turns out when I was just trying to understand why is it so hard to add climate-friendly funds to 401ks, there are lots of climate-friendly funds that exist, and some of them are doing amazing work. And it wasn't a lack of climate-friendly funds. It also wasn't a lack of 401k providers that were open to adding climate-friendly funds when they get these requests from, the thousands of employees that sign petitions at Google and at Microsoft asking HR to do this. It was actually because there were not climate-friendly funds that were checking the very specific boxes that 401k fiduciaries look to check. And it turns out that those boxes are so specific in the world of 401ks because there are a lot of lawsuits in the world of 401ks. I'm not sure about the statistic, but it feels like it might be the most litigious kind of little niche within the broader finance industry, because there are law firms that specialize in the type of class action lawsuit where employees sue their employers for having funds that are either too expensive or having funds that have underperformed compared to their peers. So these excessive fee lawsuits and these underperformance lawsuits are very common. And as a result, 401k fiduciaries have really trended towards starting to offer just a lot of index funds that have low fees and perform very similar to benchmarks. And it turns out the climate-friendly funds that have existed have been actively managed funds. That means they tend to charge higher fees and they're proactively picking stocks. And that means that the fiduciaries on these plans, who are, the CFO of a company, the head of HR, the head of benefits, and these external 401k advisors, are taking a risk in adding these actively managed funds. And they're taking an added responsibility compared to an index fund, because they have to track the performance of these funds every quarter, make sure they're performing decently compared to benchmarks. And if they're not, have a process in place to be able to flag them and ultimately replace them with better performing funds if they are underperforming. It's a big responsibility to take. And so we launched the first passive index fund that has low fees that also is climate friendly. And we're climate friendly in that we don't invest in fossil fuel companies, and we have a few other screens. And we also, for the companies that we do invest in, we vote our shares in favor of climate related shareholder proposals at the companies that we do invest in. So if groups like Josh's group are doing shareholder proposals, for the vast majority of the funds that are available in 401ks, those asset managers are actually voting on the public's behalf against those proposals by default, 98% of the time when they have to do with climate change. We're really one of the first funds offering just the default ability to know that you're voting in favor of climate-related shareholder proposals anytime any of these come up at any of the biggest companies in the economy that everyone's investing in through their 401k.
Excellent. Wow. That was a great explanation of some of the nuances of the 401k industry that I'm sure a lot of our listeners like myself have never heard before. Amberjae, before we go to break, can you give us a brief explanation, that gives us the differences between companies that are ESG leaders and ESG bad actors? Help us understand the difference.
Sure. There are a couple of differences between ESG leaders and ESG bad actors that can be either industry and sector specific or company specific. To give you an example, we don't invest in Etho Capital. We don't invest in the tobacco industry, because it is tobacco production, cultivation, farming is actually quite environmentally prohibitive, and deleterious. We also don't invest in weapons for the same reason, because war and conflicts can be environmentally problematic, obviously, right? Loss of biodiversity, loss of human life, etc., infrastructure. But it's a bit more, it's not just about what we avoid, right? Because it's easy to sort of avoid certain industries, but it's also important to look at what kinds of companies would be appropriate, except for they aren't, they may not be managing their risk appropriately. I guess one of the best examples, and I'm in California, so wildfires are an issue, which makes utilities an issue when it comes to investing, and we don't just look at sort of like the traditional metrics. We might also look at sort of how are they managing their infrastructure, how often are they improving the integrity of their power lines, of their like what sort of upgrades are they making to how they deliver and the methods through which they deliver power to cities and municipalities, etc.
Absolutely. That makes a lot of sense, Amberjae. And we're going to take a quick commercial break. We can circle back to this afterward, but don't go away, folks. There's more Go Green Radio right after this. Welcome back to Go Green Radio, everybody. So glad that you could join us. We're talking about responsible business and investing, and we're talking about making the case for ESG, environmental, social, and governance metrics. Josh, I want to go to you. Talk to us about some of your current initiatives, how our listeners can get involved, and maybe talk to us about some of the political opposition to ESG that you're facing.
Thanks so much, Jill. So yeah, ICCR members work on a lot of different issues. We have programs on climate and environmental justice. So we do a lot of work on greenhouse gas emissions and the transition, and we really work with companies in sectors like utilities and banks and others to make sure that this is done within a just transition framework that considers the impact of the transition on workers and communities. We also have a program on worker justice. We do a lot of work collectively engaging with companies on living wage, on worker health and safety, freedom of association. We just started work on the impact of technology on low-wage workers. We do a lot of work in human rights, where we engage with companies under a framework of the UN Guiding Principles on Business and Human Rights, where companies have a responsibility in that voluntary standard to respect human rights in their operations and supply chains. We do a lot of engagement with companies about labor issues and environmental issues in their supply chains. We do a lot of engagement also across sectors on their human rights due diligence, how companies are proactively addressing, as a matter of governance, human rights risks in their operations and supply chains, and taking steps to mitigate it. And I will say that there's a lot of engagement there with the tech sector, given the huge human rights impacts across the tech sector. We also do work on health equity, where we engage with companies about access and affordability of essential medicines and healthcare. And finally, across everything, we engage with companies about their corporate political engagement. So we ask companies to be transparent as investors about their corporate lobbying and about their election spending, because we're concerned that companies that are not aligning their corporate political activity with their core corporate values are creating risk both for themselves as companies, but also potential systemic risks that impact the economy more broadly. There is, it's not a surprise that there's political opposition to all of those issues that we work on, but the opposition is, as David mentioned, the opposition to ESG predates by several years the current administration. So as investors, we're having increasing impact, long-term investors like ICCR members and others engaging with companies to make the case for companies to take a long-term approach to sustainability and really addressing issues like climate and racial justice in their proactively in their policies and practices. There arose a big political opposition funded by the fossil and fuel industry and conservative political organizations. It's not really, this opposition is not really about ESG. It's really about blocking any and all progress on climate change and on these other issues that we've been talking about. And it's been a very well-funded effort. As David mentioned, there's laws in red states that are blocking state pension funds from even including long-term risks like climate, which is very counterintuitive. There are scare tactics by members of Congress and red state attorney generals threatening investors with antitrust investigations for their work on climate change. So there is a climate of fear and intimidation, and it is having some impact, but ultimately we do fundamentally, and of course under this administration, it will accelerate, but we do think fundamentally that both investors and companies know that these principles are really sound business, and that therefore in the long term they'll win out. The last thing I will say is this attack on ESG is really part of this broader attack on any and all guardrails on corporate conduct. So it's the same players that are attacking regulations, that are attacking regulatory agencies that have put in place over the last 20 years, judges that are hostile to rules and regulations. And again, the work of investors engaging with companies on these long-term issues is going to be more critical than ever as regulations fall away.
Well said. Thank you, Josh. David, to you. Talk to us about how businesses can get involved with the American Sustainable Business Network and some of the things that you are hoping for in the next, in the coming months and years.
Great. So there are a number of ways for businesses to engage with the network. So we have a number of working groups and policy area work, and including on climate and energy, regenerative agriculture, safer chemicals and circular economy, small business and local economy, conservation, inclusive and just economy. So that's where we gather together the business leaders and investors to be able to learn from each other, share strategies, develop the campaigns, and also, join together in the initiatives that we move forward, particularly around public policy advocacy. Additionally, we're trying, a number of different ways to bring forward business leaders, the responsible business leaders, to provide their perspective to Congress, agencies, state legislators, and other decision makers. And there we use a number of strategies, from in district or Capitol Hill meetings, joint statements to legislators, targeted calls and communication, and having our business leaders actually testify before state legislatures or Congress itself. Additionally, businesses can engage with our state business affiliates. So over the years, we've built up many state business organizations so that folks can have a say in the policies and practices and solutions that they could drive closer to home. And then additionally, it's to try and get their business voice out there, whether it's op-eds, letter to the editors, blogs, and just have this voice out there so that the only narrative we hear is not the one about extraction or short-term profit at all cost or greed, but it's about the responsible business voice and behavior. So for us, now is the time for businesses to step up and speak out for both the short-term and long-term interests of business, the environment, economy, and our society. And we aim to have the American Sustainable Business Network to support them and these efforts.
Thank you for that, David. Let's be brave, everybody. Alex, I want to go to you. How should people respond when their 401k provider tells them they can't add climate-friendly options or that they have a fiduciary duty? What do they say?
Yeah, we help people respond to those kinds of answers all the time. So the first thing I would say is just don't hesitate to reach out to us and ask for help in responding to this, because it turns out that employers can offer climate-friendly options and meet their fiduciary duty. There's no reason they can't do both, and we've been successful in getting our climate-friendly fund added to over 200 401k plans so far, and we can help you do the same for yours. And it really comes down to focusing on the financial reasons that it makes sense, because 401k law states that you have to just use financial measures like risk, reward, and fee profiles of funds to make the decision of what fund to add to your 401k menu as an employer, as a fiduciary. And the data is there when it comes to climate-friendly investing, especially the data I was mentioning earlier about how fossil fuel companies have already been underperforming the market. They've been the worst performing sector of the economy for the past 10, 15, and 20 years. And so we can equip you with that data and help those fiduciaries understand that this is a responsible financial choice to add these options to your 401k lineup. The other thing I always like to tell people as well is you can invest however you want outside of your 401k. So if you have retirement savings with a former employer's 401k, or if you've been saving on the side outside of your current employer's 401k, you can invest that however you want, and you can invest directly in our fund. And so go to oursphere.org to learn how to invest outside of your 401k and outside of your current employer. No one's controlling your options. It's just with your current employer's 401k where they do have that fiduciary duty to limit the options that you have. And so you have to get them on board before you can invest your money the way you want.
Got
So
it.
check out our website at oursphere.org to learn more.
Got it. Thank you, Alex. Amberjae, to you, how can our listeners invest in Etho Capital?
Sure. Thanks, Jill. Just quickly, I want to say, sustainable investing, ESG investing, however you choose to term the phrase, has existed for a very long time. Since the Quakers decided that they didn't want to advance, owning slaves, since, apartheid, shareholders have fought against, companies that were participants in the Exxon Valdez oil spill in 1989. I mean, Deepwater Horizon, this isn't a new phenomenon. So the fact that it's being treated with such sort of propagandized attention is like anathema to me because it's been around forever. The difference, though, is that for a long time, it was largely the purview of high net worth and ultra high net worth individuals and institutional investors. What we've done at Etho is we've tried to create sustainable investing products that are available to everybody, which is why our flagship product is an ETF. So the easiest way to invest in Etho, if you want to participate and don't feel like you have hundreds of thousands of dollars and millions of dollars to participate, is simply to use whatever your favorite investment product is, Fidelity, Schwab, any sort of trading platform, and just simply type in ETHO, which is our ticker. So for our flagship product, which is the Etho Climate Leadership US ETF. So it's basically, we wanted to make this available to everyone, but I wanted to make sure that people understood that this isn't it's not new. It's been around for longer than I've been alive, certainly. And I've been in the industry for 20 years. So I just wanted to make sure that people understood that. It's just that it's being treated very differently now because suddenly it's in the spotlight. But as Alex said, there are a lot of products that exist. It's really about just as stakeholders and as shareholders, advocating for yourself and for your future, so that way you can protect your assets and grow your assets and protect wealth and the environment and our society into perpetuity, which is, of course, what this is all about.
It is. It is what it's all about. Well said, Amberjae. We're going to take a quick commercial break, but when we come back, we're going to be talking more with David, Alex, Amberjae, and Josh about the need for ESG, the need for responsible business and investing. So don't go away, folks. There's more Go Green Radio right after this. Welcome back to Go Green Radio. Today, we are talking about responsible business and investing. We're making the case that ESG is important and will remain important with our guest today. Josh, I want to go to you. Help our listeners understand the concept of investor responsibility.
Thanks, Jill. There's a couple quick points I would make here. One is I mentioned earlier the UN Guiding Principles on Business and Human Rights, and they have a responsibility for businesses to respect human rights in operations and supply chains. There's a corollary there of investor responsibility under international standards that investors need to be respecting human rights across their investment portfolio. In addition, I want to make the point that responsible investment is not just about who you're investing with, but it's also, particularly when you're holding public equities, and this includes in the private equity space as well, it's about engaging with those companies that are in your portfolio to ensure that they are, in fact, not causing harm to people and planet. And so it's very important for investors to be involved in this process of shareholder engagement, investor engagement that I detailed earlier in the show. The last point I would make is that when we're engaging with companies, we're not just engaging with companies about that company's individual performance. We're also engaging companies about the impacts of that company's externalities on society. Too many companies are engaged in negative externalities, whether it's about pollution or paying a sub-living wage, greenhouse gas emissions, that create systemic risks for society. And this is not just a moral issue, as most investors are universal owners or highly diversified. These systemic risks create risks to the economy, which then negatively impact the beta or portfolios of most investors. So investor responsibility, there's a lot of components to it, but fundamentally, we believe that investors should be engaging with those companies that they're holding in their portfolio to mitigate risk, not just to those companies, but to society as a whole.
Got it. Thanks for that, Josh. David, talk to us about some of the research and data that our listeners can find on your website that shows really, really objectively how beneficial ESG is.
Great. Well, we have a number of different business case documents that one could find on our website, which is presently actually being redone a bit, but at asbnetwork.org. But there is several documents on responsible business and investing in the case for ESG. There's business case documents on clean water, clean energy, and renewable energy, on regenerative agriculture. Again, this is all based on real world practices of businesses in this country, proving over and over again that it makes good business sense to follow environmental, social, and good governance practices and the like. And what you see is the numbers have been large, right? 60% of sustainable U.S. large growth funds have steadily ranked in the top half of Morningstar U.S. Growth Index, since sustainability equity funds outperform non-ESG peer funds. Morgan Stanley reported in 2023 that, across both stocks and bonds, that ESG portfolios perform better. When we look to consumers, nearly 2/3 of younger consumers seek to support sustainable brands. And those evolving consumer preferences are certainly attracting crucial financial support from private equity investors. More and more of the millennial investors in the U.S. expressed interest in sustainable investing, signifying a pretty big, significant generational shift, towards more positive societal and environmental impact. So this progress that we've made over the last 30 or 40 years is exactly why we're seeing the pushback at this point in history and the like, particularly, as Josh mentioned, as financed by the fossil fuel industry. And, it is because of the success, is because of the investments in renewable energy, in responsible practices, in safer chemicals, and the like. So American businesses really need the freedom to operate responsibly. These attacks on ESG are political, fueled by these special interest money, and this political culture war have nothing to do with protecting business in the US other than their own particular interests. So we need to meet these with resistance. The numbers speak to the importance of ESG, and businesses and investors need the freedom to operate responsibly for a
Well,
more resilient economy.
yeah, and the notion that ESG is contrary to strengthening American businesses is kind of laughable when we want to sell things overseas. In many other countries, a lot of these B2B relationships are predicated on some of the ESG metrics. So even if we decide, fold our arms and say we're not doing it in the US and, throw a tantrum, if our businesses want to do business outside of the US, those are still requirements in a lot of places. So it's a little disingenuous to say that this is contrary to good business for American companies. Alex, I want to go to you real quick because there was something interesting on your website I wanted to ask you about. Help us understand the difference between investing in a fossil fuel company and investing in a non-fossil fuel company with a large carbon footprint.
I'm so glad you asked this because it's a question we get a lot. And it really comes down to the conflict of interest of whether it's a conflict for the company to do better on climate or not. For a fossil fuel company, if they do better on climate, it means doing less of their core line of business, extracting and selling fossil fuels. For a company that has a big carbon footprint, let's say it's an airline that flies planes, or a company like a FedEx that's doing a lot of deliveries with a big fleet of trucks, converting to a lower emission technology allows them to keep doing their core line of business and do better for climate. And more often than not, it makes good business sense because renewable energy costs less.
That makes perfect sense. Thank you for that, Alex. That makes perfect sense. Gosh, I wish we could talk all day, but we have reached the end of our time today. I want to thank you all for joining us. This was a great panel discussion. Thank you to our listeners as well. We're going to be here same time, same place next week with more Go Green Radio. Until then, have a wonderful week and do something in your